Hi, everyone. This is Jason Bierk of Wall Street for Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 14. So, Lee, there's been some really interesting stuff about corruption that has come out lately involving the CEO, the chairman of the board, and the CEO of the CME Group. For listeners who are not familiar with them, they're in charge of the commodities exchanges. So they own the COMEX. I believe they bought the COMEX, but they're out of Chicago. So they own options and futures and commodities. And this guy was on the Tucker Carlson live show on Fox News, I think about a week or so ago. And he actually had a really hilarious Freudian slip. He was making fun of SBF, the fraudster from FTX. And he was talking about it with the Freudian slip, how how SBF should have bribed the regulators at the CFTC more.
It's too much of a coincidence and too much of a Freudian slip. Everyone's been talking about it this week, and especially in precious metals community and stuff. So it's interesting. But some more corruption is occupying Fed, and they're showing the Fed calls between Jerome Powell, Larry Fink of BlackRock, and the Swiss National Bank.
Yeah, it's actually on their schedule. They're not even trying to hide it and make it like a covert op or anything like that. It's just out there in the public for all to see. And I believe the call, within a couple days, they'd engineered another short-term stock market rally between Larry Fink of BlackRock and Jerome Powell, and in the Swiss National Bank. This is the Swiss National Bank at this point. I don't think they're on the phone, though, Lee, to try to help the Fed engineer a stock market rally. I think they're on the phone probably all the time, maybe coordinating also with the European Central Bank, currency swap lines, and Credit Suisse. The shares of Credit Suisse are they below $3 a share yet, or did they do a reverse stock split? Because we know that's coming soon.
Yeah, no doubt about it. And this is not the first time BlackRock and Larry Fink have been on calls with Jerome Powell and crew. He was doing this back in during the whole sell-off during the early pandemic days. So it's not without precedent. Obviously, there's some deep collusion between these big entities.
And maybe Larry Fink at BlackRock or some of his buddies, they need another short-term stock market rally so they can unload more shares and get some out-of-the-money puts on some of their other shorts.
Sell to the greater fools, right?
Well, I suspect that there's a lot of Federal Reserve Board of Governors and other insiders, probably Congress people on both sides of the aisle here in DC, who still have a lot of out-of-the-money puts on a lot of their stock market positions that they don't want to talk about publicly.
Are you suggesting that there's a little corruption in Congress as well?
Corruption is completely and totally pervasive. As I've been saying on Twitter now for the last couple of years, there is a global bull market in corruption. And the United States looks like a banana republic, a third world country with its finances and its corruption more and more every day, unfortunately.
Yeah, no, it's sad. So what's your take on the deceleration of the Fed rate hikes? Do you think this is being driven by Congress?
I think it's being driven by math. because next year, if you just look at the math, Lee, it's going to get so ugly with interest payments on the national debt. The national debt is still growing. Neither political party, the majority of both political parties here in DC, wants to talk about spending cuts. So the national debt is still growing, and interest payments next year, if the Fed keeps hiking rates, and it looks like the next 50 basis points are basically guaranteed for the Fed's December meeting. And then there's not another meeting until February or March. And it looks like I interviewed a bond fund manager, my friend Michael Leibowitz, who's a local guy here out of the DC metro area. I've had lunch with him, I think, over half a dozen times over the years, spent hours at lunch talking about markets. And he was saying how basically the Fed, it looks like, is priced in that there's another 50 basis point rate hike for the December meeting, and then maybe another quarter point, and then another quarter point after that. And he said that's basically about it. But we were talking about that math problem. The math problem is not yet. It's coming soon, as a lot of this debt that the U.S. Treasury has, these many trillions, I think way over 31 trillion, it has to be rolled over or expires quickly, and then the debt has to be extended. So there's many trillions of this debt that has to be reissued or rolled over in the next 6, 12, 18 months. And the interest, and that's at much, much higher interest rates. So we're looking at, in 2023, $1 trillion per year in interest payments on the national debt. That is an enormous amount of the chunk of annual tax revenues. And that's assuming that the tax revenues leave for sales tax, income tax, capital gains taxes on stocks, bonds, real estate, and property taxes don't all collapse. Because if those tax receipts collapse, the Fed's going to have to do a 180 faster or do covert off balance sheet QE, and they're going to have to bail out the tax receipts and the government budgets at state, local, federal levels.
Let's talk about the interest rate hikes and the damage they've done in the real estate space. I mean, yeah, the future is what damage it's going to do with government income. But I mean, we're having a serious real estate issue now. There are almost 500,000 home buyers who owe more than their house is worth now. And Black Knight found that excluding the pandemic, the early payment default rate, which tracks mortgage delinquencies within 6 months of origination, has hit the highest level for FHA loans since 2009.
Wait, which research firm was that?
Black Knight.
Oh, I'm not familiar with them. Okay, I thought you were going to talk about the two large real estate funds, Blackstone.
Well, I'm getting there. I'm getting there.
Okay.
Because I also want to talk about the commercial real estate. So now, before the pandemic, there was a 95% commercial office space occupation. That plummeted down to 10% during the pandemic, which is just absolutely staggering. And it's only recovered to 47%.
And it's collapsing faster in areas like Silicon Valley, right? Because those companies are not a lot of those Silicon Valley tech companies are not profitable. They have to sell more and more shares or use debt to maintain just the business. So the business model was revenue growth only, sell shares to pension funds or other suckers, and then dump the shares on an IPO onto retail, cash out. If you're a corporate insider at one of these tech companies or an angel investor or venture capitalist, you're trying to cash out and dump the shares onto the retail investor because you don't think there's a lot more future growth for the company.
No, exactly. So now this collapse in real estate is obviously going to impact REITs. And it has so much so that now Blackstone and Starwood and other funds are suspending redemptions of their real estate funds.
Yeah, so just the pension funds, the suckers at the table who have large pools of capital, but a lot of these pension fund managers are not competent, and then it's either not their full-time job or they're getting suckered by slick salespeople, men or women wearing fancy suits and have large expense accounts at either a hedge fund, a private equity, or an investment bank, and they're just getting screwed over again because it was the pension funds that put many billions of dollars into these exotic hedge funds or private equity or these types of real estate investments. They were advertising that was some of their largest holdings. Yeah, so the redemptions normally means that they think that the asset prices are going to collapse more and they don't want a run on the fund where there's mass liquidations and then it causes like a vicious cycle where there's more and more selling. They're trying to stop that.
Well, anytime there's a dramatic shift in the investment landscape, pension funds typically are under covenants. They have to follow certain rules with their investment. They have to have a certain percentage in this sector. They have to have a certain percentage. So like percentage in real estate, percentage in private equity, percentage in public equity. And when any of those things get too far askew, they've got to rebalance their funds. So they've got to withdraw from some and put it in others.
Well, and especially if they're getting margin calls, right? If they're getting margin calls from their bond trades,
that just makes it all the worse. Absolutely.
Yeah. So if they're getting margin calls from one asset class, they need to sell other asset classes to raise cash. So the pension funds just have a lot of losses across the board. But according to their accounting from that interview with the pension fund expert that Adam Taggart over at Wealthion did a few weeks ago with Ted Seidel, I just bought his book on Audible, by the way, talking about who stole my pension fund money, I think is the name of the book. Written with Robert Kiyosaki, but that's an excellent interview. I had it linked on a lot of my different videos the last couple of weeks, just talking about how the accounting at these pension funds, they haven't written off 20, 30, 40% of a lot of their bad investments or asset classes yet. So even though they're getting margin calls, the majority of their investment portfolio, they haven't taken asset write-downs yet. But we're starting to see with the higher interest rates, Lee, it's brutal in commercial real estate here in the United States. Residential real estate in many areas in the United States hasn't collapsed yet, but we are seeing a lot less buyers because a lot of people can't afford a mortgage. They can't get financing right now because even if you have a perfect credit score, you're still borrowing at 7%. for a mortgage, but most people don't have a perfect credit score, don't have a good amount of assets for collateral. The real estate bubble, Lee, I just heard this from someone in Toronto who commented below another one of my YouTube videos. He was saying how prices are down 50% in some areas of the Metro Toronto area in 12 months.
Well, it's kind of ironic because as you mentioned earlier before the show, Fannie and Freddie are subsidizing now $1 million mortgages in major metro areas, and that's basically due to the price hikes that have happened in these areas on real estate. So they just had to up the limit of the mortgage that they're going to back.
Well, think about it though, because of how much real estate prices have been inflated and how much property taxes are up. What does $1 million even buy you in most major metro areas?
Exactly. Yeah, so exactly my point.
Here in the DC metro area, I know you're up in New York, Lee. So my grandparents grew up in my parents and grandparents are all from like New York area, Long Island. And the land there is still very valuable here in the DC metro area. I mean, over $800,000 in a lot of the DC metro area doesn't get you very much.
Absolutely not.
That's like a 50 or 60-year-old one-floor house with a non-attached garage. So it's a tear down. You're paying $800,000 just for the land. You're tearing it down. And in the developers, when the interest rates were low, they were building these McMansions on these things and trying to flip the house for way over $1 million, for $1.5 or $2 million on a McMansion. Right. Well, with interest rates higher, Lee, there's not as many buyers. The numbers just don't work.
No doubt about it. So, getting back to pensions, I don't know if you're familiar with this, but ALEC, which is the American Legislative Exchange Council, they're estimating a unfunded pension liability of $8.2 trillion nationwide, and I think this number goes back a year or two.
Oh, so, I think it's more than that. If you count for Social Security unfunded, you add that in too. It's even.
Well, no. This is just pensions. This isn't Social Security, and California being the worst state for unfunded pension liabilities of 1.5 trillion. Now, Biden today announced that the U.S. government's bailing out with $36 billion of the Teamsters pension funds. So we know for sure all these pension funds are under tremendous strain.
Yep. Well, most of these pension funds assume returns that are compounded annual growth rate of 6, 7, 8%. It's just not feasible. Warren Buffett has talked about this. The truth, and when you account for this, and I think also the pension fund guy who was interviewed by Taggart again over on Wealthy on the last couple weeks, Ted Seidel, he talked about this. So a lot of these pension funds, their projected returns of 6, 7, 8% compounded annual growth of that, totally unrealistic, has never happened for most pension funds. And the reality is that most of them are only getting 2 or 3%. So, and if they're very poorly run, they're getting below 2 or 3% compounded annual growth rate returns. So the zero interest rate policy environment has hurt them even more because they haven't gotten what the easy 4 or 5% on U.S. Treasuries in the past. But now that there is the ability to get that type of return on a Treasury, although that's not counting a real inflation rate, you're still paying taxes on that.
Of course, yeah.
But now these pension funds don't have the cash to go and put all their cash to work into U.S. Treasuries because they have all these other bad assets and bad investments, and they're getting margin calls.
Yeah, I mean, it's really oh God, I forgot the name of the game, but
Well, Biden's buying out. He's playing to his base. I mean,
no doubt about it. And we're talking about the mostly pension funds of the Teamsters, a la Jimmy Hoffa.
Well, look at the prisoner trade that was just done today, and we're recording this on Thursday night, December 8th. I mean, the prisoner
I didn't even want to get into that one, but go ahead.
Well, we could just add that real quick. I mean, that was to play to his base. I mean, he let like one of the most notorious arms dealers loose. We didn't even get a military guy back who was a hostage. So the trade was absolutely ridiculous. He let Putin have like one of the worst, depends upon how you look at it, but most notorious arms dealers is now free.
What a crazy world, man. I know you wanted to talk a little bit about, speaking of Europe, you wanted to talk a little bit about Credit Suisse and their currency swap lines.
Yeah, so a week ago, Credit Suisse shares were looking like they're about to crash more. And then you just saw the note come out on the New York Fed website that the European Central Bank got another $200 trillion in currency swap lines. So I think what the average person who's looking at zero hedge articles or listening to these podcasts doesn't spend a lot of time, or maybe they do reading zero hedge, sees these things and they actually think that the numbers that are released on here are honest. So that $200 million of currency swap line, the only thing that you could see that's honest is that the Federal Reserve Bank and the European Central Bank did a currency swap transaction. I wouldn't believe the $200 million. It might be another couple zeros. Yeah, because as if
you think they're massaging the numbers a little bit there, Jason?
Well, we know this from the Ron Paul one-time partial audit of the Fed and the Bloomberg News Freedom of Information Act request based on trying to get documents from the 2008 financial crisis. And they actually did sue the Fed successfully and got over 30,000 documents. And then the Levy Institute went through it. And the Federal Reserve Bank was fighting this the entire time. They didn't want to release any documents from a Freedom of Information Act request, and they don't want to be audited. Their army of lawyers at the Fed fight this all the time. It's actually hilarious how the lawyers at the Federal Reserve Bank argue all the different sides. So in different lawsuits, if you go through all the different times the Fed is sued and you look it up, they'll argue one time where they're a government entity, and then they'll argue protection that way. And then they'll argue on the other side of the line where they're a private corporation and they have protection from as a private company. So they routinely switch sides in their arguments.
Oh, yeah.
Lawyers do.
They want it both ways.
Yeah. Well, that's what happens when you're a cartel and you're government protected. So they're like the only organization that can actually get away with this. I've never seen, if they were a private company, I mean, they would have to bribe they'd have to hire an army of lobbyists, and they'd have to have the lobbyists bribing politicians, and then it would get out how much they're paying off the politicians on both sides of the aisle. But the Federal Reserve Bank really is the only entity, the only cartel, the public-private kind of, it's a pseudo thing, the way they walk the line that gets away with this type of shenanigans.
Oh, absolutely. Absolutely. So you did you want to talk about the blind spot that everyone's been talking about?
But the 200 million though number, so that caused a rally. So it looks like that amount was leaked, or the high frequency trading algorithms immediately noticed the currency swap line to the European Central Bank. Right. We don't know the real size of the currency swap line because we're not going to get actual audits of the European Central Bank, of the Federal Reserve Bank. We're not going to get audits.
No, we have a much better chance of getting Federal Reserve information than European Central Bank information.
Yeah, I mean, no one's fully honest. I mean, China just decided to, out of the blue this week, the People's Bank of China and the Chinese government just decided on their website to update their gold tonnage reserves holdings. So for whatever reason, they just decided out of the blue, first time in 3 years, to update their gold holdings.
Has China been buying all this gold to bail out Evergrande and the rest of their disasters? So you wanted to talk about that Bank of International Settlements, or BIS report going around, talking about, and there's different estimates. There's a couple different reports. One of them is 65 trillion in total dollar denominated debt when you count all these exotic derivative contracts, forward swaps. Kyle Bass has actually talked about this in the past, and other China experts, and at least, and the number back in 2015, 2016 was over 15 trillion. So a large chunk of this. And then you also have the euro dollar market, which Brent Johnson and Jeff Snyder, I think, have estimated over 17 trillion. But a large chunk of this is from Chinese banks. So Chinese state-owned enterprise banks that were used for commodities purchases, infrastructure purchases, and to build all the different either luxury condo buildings or the commercial real estate buildings, the giant skyscrapers and the other types of buildings all throughout China. So a lot of exotic, either base dollar denominated debt, regular dollar denominated debt, or these types of forwards and swaps. And there's old articles on this that Kyle Bass has linked to in the past and talked about it, and other China experts. I think Emma Mullman has also talked about this. I've interviewed her a number of times over the years about global macro and commodities in China, and she's worked in the hedge fund industry for over a decade. So they've been talking about this. They've been warning about this. It didn't become a major, I would say, red flag or signal until China had their banking system problems that everyone became aware of in 2019, about 8 or 9 months before the pandemic, because you had all those Chinese banks failing. And then within about 4 or 5 months, it just disappeared from the news. Then another 4 to 5 months later, you had the pandemic. But the Chinese banks have a very, very large chunk, and obviously they can't pay off
all that dollar denominated debt. It's just about making the payments and rolling it over. But this is just too large of a problem. We wanted to talk about this really quickly. I think it's important, though, to put this into perspective. So people see that number and say, oh, it's such a large number. Well, yeah, it is a large number. But when the larger number is the derivatives market, the over-the-counter derivatives market, which is around $1 quadrillion in notional value. And the majority of these derivatives, hundreds of trillions of dollars, according to the Bank of International Settlements, which releases, I think every 6 months, they release a biannual derivatives report. And so over 200 trillion, it might be closer to 400 trillion, which is the largest chunk of these derivatives, are interest rate based derivatives. So interest rate swaps, which are basically watching the yield curve and the Federal Reserve Bank raising or lowering interest rates. So the dollar denominated debt is an enormous problem. The Federal Reserve Bank has put out some fires in the past. I don't think we're going to see Chinese state-owned enterprise banks and the People's Bank of China, which is their central bank. I don't think they're going to get a currency swap line. I'd be pretty shocked if the Federal Reserve Bank.
You know what?
I mean, Biden may or may not be on the Chinese Communist Party payroll. We know Hunter is.
Right. We're not supposed to talk about that, though.
But I don't think they're going to get currency swap lines in U.S. dollars. I mean, China has been selling their treasuries along with Japan, and that's the other major problem with the treasury market and why the Fed can't keep hiking rates. Is the normal buyers of treasuries, the countries. Yep. So Germany, Japan, China, the really large buyers in the past of treasuries, the countries that run trade surpluses and recycle the reserves into U.S. treasuries, that's not happening.
No, definitely not. So do you think all this is going to fulfill Zoltan Posar's prediction about gold going up to 3,600 not too long a time?
I don't know about 3,600, but the gold price is acting really well the last 2 to 4 weeks.
Yeah, no doubt about it. It's definitely been one of the stronger markets.
It's acting as a safe haven for the first time in probably 2 years, in over 2 years. Yeah.
Yeah, Bitcoin certainly isn't. All the cryptos are just getting crushed, man.
Well, look at the bank stocks too. I mean, Jim Cramer was recommending bank stocks as a screaming buy only a month ago. Yeah. So as usual,
do you short what Cramer recommends?
I don't do a lot of day trading, but yeah, I mean, if you buy what Nancy Pelosi's buying and you don't buy what Jim Cramer's recommending, then you probably have
pretty good. Oh, it's too funny, man. It really is. What a world. I think we touched on everything. Is there anything else you wanted to cover?
There's a few more things here that I have in my notes. So China updated their gold holdings, like I said, an increase for the first time in 3 years. So the question then, and we're seeing a lot of these articles go around, was China the only mystery buyer in Q3 2022? I would say no. My educated guess is no, based on what happened in the 1970s. I talked about this briefly in my last interview with the money manager and show host, Zach Abraham, where in the 1970s, the oil producing countries, the large oil producing countries in OPEC and elsewhere, when oil prices are high and they have larger profits in oil and natural gas, they tend to buy a lot more gold tonnage. So I think that's what was showing up in the numbers, even though a lot of these countries, so like Qatar, Saudi Arabia, Iran, Iraq, weren't necessarily disclosing it. I think the oil producing countries were buying a lot more physical gold tonnage along with, so I think China did buy, but I don't think they were the only buyers.
Yeah, I highly doubt that they were only buyers.
Yeah, and we were talking about the Hunt brothers before we started recording. Yep. So the Hunt brothers actually, they copied the oil for gold trade in the 1970s. So they didn't come up with it on their own. They were
they more than copied it.
They got greedy. Yeah, they took out way too much debt on oil futures. They took out way too much debt on silver futures contracts, and in the CME group, the COMEX, all those guys changed, the U.S. Treasury Department, all those guys changed the rules on them. It wasn't a market anymore. I mean, they had sell-only liquidation days. Yeah. For our listeners who are not familiar, the famous trader Jim Sinclair was actually hired to be the trader to liquidate the Hunt brothers positions.
What a time that must have been for him. Can you imagine?
Oh, the Hunt brothers were, and this is the environment we're in now. Look at the Fannie and Freddie rules, the rules changes on the mortgages. So the government is just pulling all these levers. The central banks and governments are just pulling all these levers, changing all the rules. In England, what they were doing bond buying, quantitative easing, and raising interest rates at the same time. Just a totally clown world, ridiculous, dystopian. Yes. They're trying to do two contradictory policies at the same time.
It's Rube Goldberg economics.
Clown show. It's a clown show, and we're just trying to live in it.
But so you think we should talk about oil before we go?
Oh, for sure. That's been kind of the surprise here. So the phrase just demand destruction, but China's starting to reopen right now. So there's a lot of evidence that China's going to be reopening. There's a lack of oil inventory globally. Natural gas and LNG demand is still growing globally, even though there's some demand destruction in Europe. But the European Union is going to have, it looks like they're going to have a cold winter, and they're going to have to import either natural gas from liquefied natural gas.
Not in the short term. They're going to have to do something, or there's going to be some serious civil unrest over there, because people are not going to be wanting to go through the winter without heat.
Well, they say they have enough natural gas for now, but if the winter is colder than they expect, then they'll run out of it.
Yeah.
So they'll have to buy more. Also, they have so many fertilizer plants shut down in the European Union that they're going to have to import all the key components.
Well, I don't know if you've been following the news on the fertilizer situation, but more and more governments are cracking down and saying, "Oh no, you can't use nitrogen fertilizer." They're really squeezing the farmers over there. So it's going to be an interesting time to follow the agricultural market over there.
Yeah, for listeners who are not familiar with what's happened in the oil market, the oil prices, the West Texas Intermediate oil prices here in the United States, they're down $10 a barrel in just the last over $10 a barrel, excuse me.
Yeah, it's trading right now about 72.
Yes, and $20 a barrel, the price is down in the last month. So we were at $88.90 on November 8th, and now we're at 70? Let me pull up real quick. Oilprice.com chart.
Well, back in March, we were trading at 125, 129, almost 130 at one point.
There was also the risk premium in there, though. Remember, from Russia and Ukraine.
Yes. Yep. No doubt about it. But it was way overbought at that point. I mean, it was.
Well, we're getting kind of very close to the danger zone, where if oil prices go another $5 or $10 a barrel lower, you're going to have a lot of the higher cost companies. And a lot of these oil companies have much better balance sheets than they did even a couple of years ago. They have a lot of their debt paid off, but we're going to be down another $5. If we go another $5 or $10 a barrel lower, the higher cost oil production, there's not going to be investment into new oil and natural gas wells, the cost to drill. These oil service companies have to raise prices. They've been telling the market for the last 6 months that they have to raise prices, because you had Schlumberger. We were talking about this on prior shows over the summer, that Schlumberger in Q2, their Q2 earnings number, they were cash flow negative despite the oil prices high, which meant that they were going to have to raise prices to drill new wells. So it's looking ugly from a profit margin standpoint for these oil service companies. They're going to have to raise prices. With the oil price going down, you're not going to see the normal discounting, I don't think, for the oil service companies cutting prices to get wells drilled, because they need to raise prices. We saw that with their earnings reports out the last couple of quarters.
It's a very similar conversation right now to the one that we've had about miners, gold and silver miners, over the past few months, with the price going down so low.
Well, that's the funny thing now, Lee, is that the lower oil prices and diesel prices and electricity prices in other countries are not necessarily going to go down at the pace that the oil prices are. So there's still problems and higher prices, diesel globally. Same thing for electricity in a lot of these other countries. So you have to watch it on each individual mine. But if oil prices do stay low for the next 6 months or a couple quarters, and I don't know if that's guaranteed to happen, because I think at some point in the near future, I think you're going to see larger OPEC cuts. So I think you'll see at least 1 million barrel per day cuts from OPEC soon. You might even see 2 million barrels per day cuts from OPEC, and that's with their own production numbers still falling. So they might come out and announce saying that their costs are up, the oil industry's costs are up, the cost to drill wells are up, their profit margins are at stake, and they're going to just cut production, then saying that a lot of their production at certain oil prices is not profitable anymore. They're just going to cut supply.
Yeah, no, I can't see oil prices staying down where they are. I'm
Well,
sure that they're going to be
also, well,
bouncing
also
at least.
the other argument is that also, unlike for gold and silver, you also have OPEC, which is a cartel outside the United States, and if they want to, they can go in there and they can legally, do a supply cut, legally
Yes. Yep.
manipulate the market with oil production supply cuts. And the OPEC, a lot of the oil ministers are saying there's been a ton of paper price manipulation in the oil markets for the last 6 to 8 months, preventing big spikes, preventing the price from staying high. Well, if they still believe that, they can just keep announcing production cuts. So I think that's what's going to happen. You're starting to see profit margins for the higher cost oil companies come in jeopardy. The oil service companies, they're going to have to raise prices. It's a mess out there for the oil companies that are higher cost producers and the oil service companies.
Yeah, no doubt about it.
But a lot of these oil companies are actually hedged though, Lee. So some of them already hedged their oil at $90 a barrel for the next 12, 18, 24 months. They locked in a higher oil price. They locked in natural gas. They hedged it at 6 or 7. So they have a lot of their production already hedged. So a lot of these US and Canadian companies, these shares are down 30 or 40%.
But they're going to be much more stable than other unhedged.
Well, my point is that the businesses themselves are still generating enormous amounts of cash.
Yes.
They don't have to go out and panic and do dividend cuts or fire a bunch of employees if they don't want to, because they locked in their cash flows at more stable energy prices than currently. So there's a dislocation between the price of oil and natural gas and these company shares.
As there should be.
Well, the dislocation is larger than normal. I mean, a lot of the oil bears are saying they're predicting like an even larger crash for a lot of these oil stocks. But the costs for drilling new wells, the production costs, the cost for drilling new wells are up a lot in the last 2.5 years. There wasn't a lot of new supply except for natural gas brought online here in the United States. A lot of countries actually didn't increase natural gas production.
Well, not only that, it's not like they can just turn it on overnight and start producing. So that, there's a time factor there too.
Well, it depends if the wells are onshore here in the United States. So if you're in Texas or Oklahoma and you're near a pipeline and there's plenty of oil service companies to choose from, you can start drilling new wells fairly quickly. So in 6 months, you can have some new wells online. It depends which country or if there's infrastructure. So if you're England and England's talking about fracking wells, I mean, they don't have a lot of infrastructure there. They don't have a lot of pipelines. If you're starting from scratch and you don't have the oil service companies there in the pipelines, it's a lot different bringing a lot of new production online.
Sure.
But you brought up the gold miners. So if energy prices do stay weak, that will help the gold miners. That will help the base metal miners.
Oh, absolutely. It'll help everyone.
Well, those are your copper miners, your open pit copper miners. So your Freeport McMorans that are large scale, low grade, open pit copper and gold miners. So Newmont Mining, which produces an enormous amount of copper and gold, but they have a lot of open pit, low grade copper and gold mines, or a primary copper miner like Freeport McMoran, which also has an enormous amount of gold byproduct. So you just have to watch the energy prices. But those countries, excuse me, those miners are operating in emerging market countries, and those countries, the workers want higher labor costs. So just because electricity, diesel, energy prices may fall does not mean other costs may fall. The labor costs may go up 20, 30, maybe even 40%. And this is, again, why I prefer royalty and streaming companies and why I write about them and cover them so much in articles for my patrons, because you don't have to worry about this. So
almost every episode you mention them.
Well, it's you
really like them.
Well, I sleep better at night.
I understand.
I don't have to think about the diesel costs and the electricity costs and the labor costs. It's okay. They own a basket. They own 20, 30, 40, sometimes more than that, streams or royalties throwing off different cash flow all over the globe. It's like owning a mining stock exchange traded fund, except it's more efficient than that.
It makes perfect sense to me. Is there anything else you wanted to cover, Jason?
Not market related, but I'm having some serious health problems here over the last 6 weeks. So I'm going to have to go see some specialists here, and I may need a couple serious surgeries in the not too distant future.
Well, you will certainly be missed if you take any time off, because I know you have a pretty good following.
Well, Lee, I think that's it for episode number 14 of Finance Unspun. Bottom line here, though, is that the dollar index, let me just pull it up real quick. I think it was a little below 105. The dollar index.
Yeah, it was like 104 something last time I checked.
Yeah, it's a little below that, but there's still a lot of problems. We've had a tiny bear market rally. I'd be very skeptical because what I'm seeing with consumer behavior and shopping, the increases in credit card debt and consumer spending, a lot of it was inflation related and not because the consumer is necessarily getting a higher income. It was the increases or the maintaining of consumer spending and the increase in credit card debt was inflation related. So inflation, I think consumer credit card spending was up about 17%. I think I saw on a chart, and that's almost exactly the number that John Williams of Shadow Stats has for his 1980s formula for the actual consumer price index.
Exactly. You know, what's interesting, I've spoke to a few retail stores over the past couple of weeks, and they're all telling me that their business is terrible. Now, I know people have shifted online. I get that, but not everyone has. And I think if they're down locally as much as they're saying they are, I think it's universal. I just think people just don't have the money to spend on things.
Yes. And with the higher food costs, energy costs, rent, now you may see some of those numbers fall down. We've had commodity futures contracts be in a downtrend now for over 6 months. But in reality here, I mean, I still go out to eat at restaurants once or twice a week with my best friend, and there's still shrinkflation on menu prices. The portion sizes are dropping and the prices are going up. So the consumer price index, CPI, or changing propaganda index, is not accurately reflecting reality at all. I'm still seeing menu prices of shrinkflation at the grocery store, shrinkflation at the restaurant, and prices are going up too.
Yep. On that note, Jason, I hope everything gets better for you, and I'm looking forward to our next show, whenever that may be.
It depends on how many current events, because I think we're not going to have a problem in the next 10 days to 2 weeks. The rules changes, as I made on an episode, a short video a couple of years ago, I was predicting this, that we're going to have Fast and Furious rules changes. So they're going to. So it's Fast and Furious. It's a new movie. It's the government and central bank rules changes edition of Fast and Furious.
Starring Larry Fink.
Yeah, he's like the flubby version of Vin Diesel. It's like Vin Diesel when he's not on steroids, when he's taking a break between movies. If you've ever seen one of those paparazzi pictures of Vin Diesel when he's not working out, I mean, he looks like a 300-pound man, smoking cigarettes, walking around with like a giant beer belly.
On that note, let's say goodnight, Jason, and we'll talk to you soon.